The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and this is our hour to talk taxes. Look we got 46 days until 2020, and that's the end of the 2019 tax year. And so we want to make sure that if we can save you money, we're going to take every one of these 46 days to do that. And I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey there, Esther. Happy Saturday.
Happy Saturday to you. And Christopher Fabian.
Hello, Esther.
Hey, Chris.
And you
How
know,
you guys
since it's 46 days to tax
2020.
That means it's only 39 days till Christmas.
That's true.
We just
I
went
was
to
in
Michael's
a store
today. You
and
saw
I
that.
I just couldn't believe. I know that. Yeah, they're playing Christmas music, and it is even Thanksgiving. I know they started right after Halloween, so
Yep.
what are you going to do? All right, let's talk about. We're talking about capital gains. I think probably capital gains is one of the most misunderstood areas of taxation, and so we want to make sure, especially since people got 46 days to affect some change if they're in the market. And let's face it, the market's doing phenomenal. We want to talk about the difference. People will say to me, "Oh, I got to pay the capital gains." Well, actually, that's one of the best treated areas of taxation in the whole tax code, and we're going to talk about that. But before we do, I wanted to talk about some of our upcoming things that are happening at EG Tax, right, Tiff? Chris?
Yep. We have the Banking on Your Business seminar is December 7th at 10 in the morning, and it's just a great opportunity. We're going to have experts there from all different areas, and if you have a small business, a medium-sized business, large business, or you're thinking of starting a business, it's a great opportunity to learn things from A to Z about business, and then also leaving a succession plan for your heirs, because let's face it, sometimes it's it's good to have a business that you can leave and turn over to somebody else.
So we're going to talk about like the difference between a sole proprietorship, a LLC, a partnership, subchapter S corporation, C corporation. Should you be in a C corporation? Should you move to an S corporation? If you're an S, should you move to a C? Should you do an LLC? I mean, you might say to yourself, "Oh, who cares? That doesn't sound exciting at all." Should I buy some equipment before the end of the year? I'm going to tell you, this seminar could save you thousands of dollars. It's a free service that EG Tax offers, and so if you have a business or if you have rental property and you wonder about the pass-through, how the pass-through works, and if you make that election to have the pass-through from your rental property on your tax return, how it affects all your future year returns, come to the seminar. There's no charge. It's a public service that EG Tax offers, and they can register online, right? Or over the phone?
Correct. Yep. They can call us at 632-78886 or go to the website egtax.com and register that way. Like you said, it's a great way to learn how it may not impact you today, but in the future, it could help you save a lot of money.
But the truth of the matter is, if you're sitting down and you never even, you think, well, I was going to buy that truck in January, and you buy it now for business, and it's because you really need a truck. But if you do it now, you might save $10,000-$15,000 in taxes just by doing something in December. So it all depends on your business, how much it would save you, what your tax bracket is. But we're going to explain all that, and there'll be tax experts there and financial experts there to help you with your business so that you can maximize your deductions, minimize your tax liability. And we're also going to do things about, maybe you don't have an employee benefit program. We're going to help you with that too. So, I think it's really worthwhile.
Yep. Or even, do you have a retirement plan? What's the correct retirement plan for you if you're self-employed or have a corporation?
Yeah, and then I gotta say that when we have a seminar like this, we always try to have fun. It's not stuffy and stodgy.
Oh no,
it's just a good
we're
time.
not stuffy and stodgy anyway, right?
Yeah.
Right?
Never.
Okay, and then the other thing is EG Tax has EG Health Connect.
Right. Yep. Helping people with their insurance needs, whether it's Medicaid, the Essential Plan, or Medicare. Tim Eliason runs that up, him and his helpers. And every Wednesday.
I thought only Santa Claus has helpers.
Well, we all need helpers.
Right, we do need help.
Yes. And every Saturday and every Wednesday, he does have seminars to help people with the Medicare side of things, because that open enrollment will end December 7th. And he came into my office yesterday and started talking to one of my clients, and they were a little confused. And he goes, well, that's why I want to help you go through the 60 different plans. And they said, 60? When I worked, I had 2 choices.
Now you really got choice.
Now you really got choice. And that's what he does. Him and his staff take the time to go through to see what is the best one for you.
You know, and the sad thing is to listen to people. You know, sometimes it's like being a deer in the headlights. You just go, you don't know what to think, so you do nothing.
Yep.
And probably that's the worst thing that you can do.
Right.
I mean, it is the worst thing you can do, because really knowledge is power. And EG Tax is there to help you. Tim Eliason is our president of EG Health Connect, so you can call us or go to our website.
Yes.
And he'll help you. And the truth is, it is true, open enrollment ends December the 7th. But if you have a, what do they call it, like a defining
a life-changing.
A life-changing event, you can change your health insurance all the time. Like if somebody passes away, you have a change in your job, your health situation changes, you're moving, all that kind of stuff gives you an opportunity to change your health insurance. So don't be intimidated by that December 7th date.
Correct.
Right?
Correct.
I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone, and you can text us at 3930. And I wanted to talk about capital gains. And again, you can talk about whatever you'd like. You know, our lines are open for whatever you want. But if you have any questions on capital gains, this is what we want to talk about today specifically. Capital gains get special treatment. Now, for instance, the regular tax rates are 0, 10, 12, 22, 24, and so on up.
Right.
Capital gains, if you're under the 15% bracket, if 15% or lower, and that would be 12%, then what would you pay on a capital gain? What rate of taxes?
You said if you're in the 15%
Under.
Zero.
Yep, 0.
Zero. Nada.
Right? So the 12% ends if you're married filing a joint return at $78,950. So if your income is under $78,950 and you have a capital gain, unless it's a very, very large one, you may pay 0% in capital gains. Now, if you had wages and you're in the 12% bracket, if you had $10,000 in wages, you would definitely pay $1,200.
That's right.
Right?
Yep.
But if you have capital gains of $10,000, you would pay 0. So to me, that's very cool. So what people don't, sometimes people say, oh, I got to pay the capital gains. I'll give you an example. Let's say you have $10,000 in interest in your, you're a CD kind of person, and you have $10,000 in interest, and you worked hard, and they're not paying you that much, but you got that money socked away. $10,000 in interest, if you're in the 12% bracket, would cost you $1,200 in taxes, plus the state of New York. If you moved that money from a CD to a qualified dividend, what would they pay?
0.
0. So instead of paying $1,200 in taxes on that $10,000 interest, you'd pay 0. So you'd have the whole $10,000 working for you. So these are things that people don't understand, and that's what we want to talk about to make you smarter than the average taxpayer.
I know.
investor here.
The other day I had a caller who called in the office with a question. He's like, okay, so I'm going to take pension money out of my pension, but I don't have to pay capital gains on it. I go, no. He goes, are you sure I don't have to pay capital gains? I'm like, no, it's your regular tax rate. It was
worse.
like he was scared and he just didn't want to pay capital gains on it.
Right,
But the
right.
truth is the capital gains tax
Would have
is
saved you money.
Yeah.
Right?
Yep.
All right, why don't we take a short break? 803-0930, 803-0930, star 930 on your cell phone. You can text us at 3930, and we'll be back on the other side with your questions and comments. Hey, we are family. We think of you as family. I'm Esther Gulius, the tax lady from EG Tax, and we want to help you out with your taxes. Get ready for 2020. We got 46 days to effect some changes to 2019. Our phone number is 8030930, 8030930, star 930 on a cell phone. You can text us at 3930, and we have Mr. Joe from East Aurora has been hanging a long time. Hey, Joe, how can we help you, sir?
Hey, Esther. I just had a question for you.
Yeah.
As far as next year, as far as the tax rules and stuff, is the tax rules going to be the same as what they were last year with that $24,000 for like your standard deduction?
Those have increased slightly. Now it's 24.4. Married joint, 12,002. Single is the standard deduction on the federal for married filing joint or single.
And the SALT is still there.
Yeah,
The state and
that's
local.
still in place. They've modified some of the deductions and increased them for cost of living, but pretty much and what they've done is some of the rules that were kind of cloudy, they've firmed some of those up, but basically the tax law is the tax law.
No, I'm good with that because that last year was the first year we've actually kind of really benefited having that, but I didn't know whether they,
So far, so good. They still got 46 days to change it, but right now that's the way it is.
Yeah, so basically, out here we're in a big tax district.
That's for sure.
Well, to me, pushing $10,000 a year is a lot.
I know it's for New Yorkers, it's really a very sad thing. And they were not. I know that the state of New York was litigating that the SALT deduction limitation wasn't fair, but that went nowhere. So right now, it's still the same as last year. But again, the state of New York. You may not be able to itemize on the federal, but you can itemize on the state because that limitation is not in there on the New York State return.
I think something that really bothered me, Esther, is that I found a lot of my single clients were still itemizing, whereas married people
That's
weren't.
true.
And
That's
so
true.
that really, I just didn't find that to be equitable.
That's true, especially two single people living together,
Yeah.
right? So they'd both get the 12,002 deduction if they didn't itemize, but coming up to that $12,000 threshold is a lot easier for a single person than it is a married couple.
Yep.
So, well, thank you for calling, Joe. Have a great day.
Very good question.
Okay, I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone, and our text number is 3930, and we have Ed from Tonawanda. Hey, Ed, how can we help you?
Okay, with regards to minimum distributions from the
The RMD?
57 plan, that's not considered what you're discussing now, the,
Capital gains?
right.
No. Okay, so capital gains get special tax treatment in a good way. All other forms of income, pensions, which you'd be talking about, interest, wages, sale of machinery and equipment is all taxed at the regular tax rate. So if you're in the 12% bracket and you're married filing a joint return, you're going to pay 12% on your wages, 12% on your pension. But if you had a capital gain, you'd pay 0%. So capital gains are taxed at a lower rate and are favored from a tax perspective as opposed to everything else that's taxed at a regular rate.
But if I have, in effect, a profit on my in my investments in my 457, isn't there capital gains?
No, because your 457 is a pension plan, and all monies that come out of a pension plan are taxed as ordinary income.
Okay. All right.
Okay.
Thank you.
All right, thanks a lot, Ed. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. 3930 is our text number. Did you guys want to add anything?
One thing with Joe, a lot of people wait till they're 70 and a half to start taking their minimum distribution. And it could actually end up costing them money because if they retire at 65, that's 5 years where maybe their other income isn't enough to file a tax return, where they have room to take that money out of their pension plan now and not pay tax and reduce that minimum distribution later on.
Very good
Yeah, like
point.
let's say for instance that you had saved $100,000 in an IRA, and you're 65, you're retired, you're living on Social Security, and you're saying to yourself, I don't have to take the money out of my IRA. I don't have to take the money out of my IRA. I don't have to take the money out of my IRA until I'm 70 and a half. The truth is, none of your Social Security is taxable if that's all you have. If that's all you would have had. So you could have actually taken out like almost $20,000 out of your IRA tax-free. So sometimes people waiting for this required minimum distribution is actually doing yourself a disservice, because if you're paying zero taxes, take the money out tax-free.
Right. And then I also want to chime in and say, don't forget, if you're over the age of 59 and a half, the first $20,000 is excluded off of New York for both husband and wife if you're married. And if you're working from a municipality or a New York or a government pension, it's all tax-free.
Publicly funded pension.
Right. It's all tax-free on the state of New York. So New York State is kind to retirees, and all
That's
their Social
correct.
Security is
That's
tax-free
correct.
on the state of New York.
Okay, so let's talk about capital gains. I would love people to understand that. First of all, what is a capital gain? Can you guys kind of quantify that in a simple way for people to understand?
Sure. We'll keep it simple. We'll say it's a stock you have in ABC company, and as long as you held it for more than a year, so
it means that you owned it for more than a year. If it's less than a year,
it's regular income.
it's not a capital gain.
Right.
It's not a capital asset.
Correct.
If you hold it for more than a year, then it's a capital asset, and it gets a special tax treatment. Looks like the fairy comes in and touches it and says, "Oh, you don't have to pay that much in taxes because you have capital assets," right?
Right.
Chris?
Right. Yeah. Sorry, the text just came in and it caught my eye. I
okay.
apologize.
That's no problem. So, really, capital assets are really kind of negatively defined as something it's not. It's not cash.
Right. Yep.
It's
Not
not
collectibles.
inventory. It's not collectibles. That's what it's not. Everything else is considered to be either a personal capital asset or an investment capital asset. If you have a capital asset and you sell it at a gain, then the maximum rate you can pay is
It's capital. Is 15%, unless you're in the highest tax bracket, which is 37%. But you would have to have over $500,000 in
and
income.
that rate would be what?
20%.
Right. So you might be in the 37% federal tax rate, but if you sell a capital asset, the max you can pay is 20%. Most everybody else is going to pay zero.
Yep.
So, I mean, a capital
It's
asset is a
favorable.
great thing. So, number one, a capital asset is something other than inventory, depreciable equipment, depreciable assets, cash. That's what a capital asset isn't. But when you take a look at your pen that is sitting in front of you at your desk at home, that's a capital asset. Then you say, well, that doesn't look like a capital asset to me, but it is, because if you sold that pen at a gain, the IRS would expect you to pay taxes on it, right?
Correct.
How about if you sold it at a loss?
You'd get
Not
to take
deductible, because it's a personal capital.
It's
Right,
a pen.
for a
Yeah.
pen,
Yeah.
Because it's a pen. Because let's say that you found this pen in the backyard and it's worth $1 million. Right?
Right.
And you sell it for $1 million, then they would expect you to pay taxes on it. But if you went to the store and bought the pen for $2 and you sold it for $1, they don't expect you to pay taxes on it. That's why when you sell things at a garage sale, you're selling personal capital assets, and it's not taxable because you're selling them at a loss,
Right.
right?
That's
Correct.
right.
Generally,
Right.
most of the time. So if you sell capital assets at a gain, the max you're going to pay, if you're in the highest tax bracket, is 20%. Most people in the 12% bracket or less, 15% bracket or less, are going to pay 0%. So that's a deal. The other thing is that people have to understand and the gain is not on what you sell it for. The gain is the difference between what you paid for it,
Plus any.
right, plus adjustments,
Yep.
and what you sell it for, plus the expense of sale.
Right. So that requires work also.
Right.
I've been in that position with
you
clients.
you might have had a stock that you bought for $10,000 and you reinvested dividends year after year after year after year. So you might have paid $10,000, but you had reinvested dividends of $8,000. So now the stock holding is $18,000. And if you sell it for $20,000, you only have a $2,000 capital gain, right?
That's right.
And
That's
if you're
right.
in the 15% bracket or less, then you pay 0% in taxes.
Correct.
So I just thought it was important to talk about because I think a lot of people
Get
don't
mixed up.
understand about their capital gains. Now, your stock portfolio, those of you that are invested in the stock market, what about all of their dividends?
Those you also have to pay tax on, and it depends on the holding period to determine the
If
taxability.
they're qualified or not.
Right.
Right.
And we can talk about the qualified dividends.
Yeah, we
and
have
the
to
tax.
take a break for the news. 8030930, 8030930 is our phone number. Star 930 and a cell phone 3930. We're going to take a short break. We'll be back on the other side with your questions. Hey, family, I'm Esther Gulias, the tax lady from EG Tax, and we love helping you. To us, your family, 8030930, 8030930, star 930 cell phone, 3930 is our text, and I think we got a couple texts. Should we go to the first text?
Yeah, it says, how much can I write off for dental and medical costs?
Well, if you're an itemizer, your itemized deductions this year, your cap has to exceed 10% of your adjusted gross income for 2019. So all of your medical expenses, once they get over that 10% of your adjusted gross income, are going to be deductible if you can meet that threshold. So especially with people paying a lot of medical expenses, their health insurance, and the like, many people do itemize their medical expenses. Right, guys?
Yeah,
Right.
They absolutely do.
And especially on New York State.
Yeah, and then also I have a lot of clients who pay for a handful of who pay for long-term care insurance, and
So
that's
not
also,
only is it deductible on the federal, you get a credit on New York State.
Yep, you do. So there's if you pay for that long-term care insurance, you get to double dip and take the advantage there, and also on the state of New York. So there's a lot of medical. Of course, it's a harder toll to get up now that we have a larger standard deduction. But as Esther said, it's also something you can take advantage of in the state if
And
it
the
doesn't
other
work on
thing
the
is,
federal.
if you're close to meeting that threshold, you want to load up your medical expenses in 2019, right? Like, for instance, let's say that you have a medical bill that you said, I'm going to pay that in January. Well, if you can use medical as an itemized deduction, it makes sense that you'd load it up into 2019 so you can take as much as possible on your itemized deduction under medical.
Yep. So you might have kids that are thinking about getting braces, load it up like you
March
said.
them into the old
Yep,
dentist here, 46
that's right.
days.
Exactly.
Okay, and then we also have another text here from the second one.
It's from Rochester, and it's hey guys, great show. I sit in the driveway and listen. I didn't want to miss a word. Is there a recording of this episode?
Yeah, there
Yes.
is. Don't we keep
Yep,
it on our website?
On our website at egtax.com. Tim puts it up there, and it's a great opportunity. You can go to egtax.com and read it at your own leisure.
Okay, and then let's go to the phones, and we have Nelson. Hey, Nelson, how can we help you, sir?
Hello, Esther. I've done business with you in the past, but I have a simple. Hopefully, it's a simple question.
Sure.
I'm not sure you're aware of this, but I know Trump is establishing the thing in his next term, if he gets in, that he's going to be changing this what's called the estate tax. So it's real estate. He wants to assign your purchase. The purchase price is what you'll be taxed on, not the asset gains that you get over years. For instance, I paid $46,000 for this home back in '76. Now SB will be about $340,000. Okay, so based on that, the only way I can avoid taxes is if I die and I leave it to my daughter. There's no tax on this piece of real estate.
Well, no, that's not true. If you sell your personal residence and you've lived in it 2 of the last 5 years, gains, if you're married filing a joint return, gains up to $500,000 are tax-free.
Okay, but I'm just saying, if I sold it right now, I'd be paying taxes on
No, if you sold it right now, you'd pay no taxes.
Oh, really? Oh,
yeah.
Okay. Okay.
If you're talking about the inheritance tax, right now, if your estate is less than $1 million, I think it's $11,400,000, you don't pay any estate taxes at all right now, and it's $22,000, $600,000 or $800,000 on married filing a joint return second to die. So
I think you, like you always say, he's confusing apples with oranges, right?
But right now, that's one of the things I wanted to talk about next. So thank you, Nelson, for bringing this up. Your personal residence is a capital asset, and it has special tax treatment. So capital gains are special. But your personal residence, you can sell tax-free up to $500,000 tax-free every 2 years if it's your personal residence, $250,000 if you're single, and you don't have to invest the money. It's just your money, completely tax-free. And talk about a great tax loophole, a great tax break. Your personal home is a great tax break.
Let me add another element to this thing.
Yeah.
There is an apartment on the property, and that's
okay. Well, that's a horse of a different color.
That's why I raised that question. I wanted to...
Okay, so we are talking about capital gains. Everything's a capital gain except for depreciable property, inventory, cash, collectibles. Now, your rental property is depreciable, so it's not a capital asset. So when you go to sell it, you have to recapture the depreciation if you are actually selling it, and the year of sale. So, but much of that ends up to be recaptured if you haven't been using accelerated depreciation as ordinary as capital gain anyway. But you have to use a 4797. Now, if you wanted to, your personal house that has a rental on it, you could do an exchange, a tax-free exchange, and buy another piece of investment property and exchange the gain from the first place into the second place, and that's called a 1031 exchange.
That I do understand. So the only way around any taxes I would do is if I will this place to my daughter. She starts out with a zero. Well, I think it's a zero asset. Is that how it's?
No. So if you, all right. So and here's another good planning tip. So you have your rental property, right? You're saying that this is rental property.
Yes.
And you're not putting your daughter on the title. It's going to go through your estate, right?
Exactly.
Okay. And your estate is not worth over $11 million, right?
No, it's not.
Okay.
Less than that.
So your daughter would then inherit the property at the fair market value on the date of your death. So if it's worth, you said, $350,000, that would be her cost basis. If she sells it for $350,000 the next day, there's no capital gain for her.
That's exactly what I wanted to hear. That's how I've interpreted.
So you're not planning on dying, though, right, Nelson?
Yeah.
Not right now.
I think I'm getting close. I've been in the hospital twice this year, Esther, and both times it was close to death. And
oh, no.
Oh, yeah.
Well, the good thing is, and I mean, one of the best ways, I have to tell you, that's one of my plans, is to die out of it. So, but I will tell you, your heirs, in the event that they inherit your property, your capital asset, because of death and went through the estate, they get a stepped-up basis, and they won't have to pay the capital gains if they sell the property right away.
What I have done, and I hope you would agree with this thing, everything I own is paid for as personal property. Everything. A lot of stuff. Let's just say that. And it's probably worth, I'm told, maybe $500,000 between my home and all this other good stuff. And I'm leaving primarily everything to her.
Okay.
And whatever she does with this thing, with the money she gets from it, with the rest of the family, et cetera, is up to her.
Right.
Discretion in her lap. But as far as avoidance of this tax, Because I went through the taxes. If this was not the case, I'd be paying through the nose on this darn thing based on the value I paid for this thing originally. And
Well, so is this a 4-family, a 2-family? What is it?
basically, it's 3-family. I've got a separate home on the property, got an upstairs apartment, and I have my primary residence, which is quite huge. And it's a beautiful.
So actually, Nelson, in the event of a sale, it's handled as two different sales, right, Chris and Tiff? You want to explain it to him?
Yep, because since it's personal and business, your personal side, we get to use that exclusion, like Esther said in the beginning of the call. $250,000 gain on your personal side would be tax-free.
$500 if you're married.
Yep, $500 if you're married. So that part you wouldn't pay any tax on. Then we have to get into the rental side and look at to see what your basis was, take half of the sale price, and figure out after depreciation what the gain is. And that is what you would pay tax on if you were to sell it today.
So let's say, Nelson, that I'm assuming your personal home is worth more than the rental properties. Is that right?
Well, in total, the whole property is worth about $340,000.
But if you were to allocate your personal portion, your home, what would you think that would be worth?
$250,000.
So most of it is your personal residence, right?
Sure, I would say so.
All right. If you sold it, that part would be completely tax-free. So if you sold it right now, while you're alive and kicking, that portion would be tax-free. The extra $100,000 that you would get on the rental part would be the only part that would be taxable. Do you have a lot of income right now, pension plans and things of that nature?
Pension. I'm holding the mortgages on 2 different facilities. I got a couple of promissory notes that provide income every month.
All right, so probably we'd be looking then on the investment portion 20%. And so that would mean on the sale of the rentals, it'd cost you about $20,000 in taxes. So that's what would be the bottom line.
Yeah, and I think that's something I could easily eat. I'm not that doesn't.
Sure, of course.
So it's.
Well, I hope you stay well, Nelson.
I do too a little bit, but boy, with the aches and pains, I hate putting my socks on in the morning.
Well, thanks for the call.
Okay, Esther, thanks.
All right, thank you. Bye-bye.
I'm
Esther Gulius, the tax lady, 8030930, 8030930, star 930 on the cell phone, 3930. Yes, Mr. Christopher.
I had a client come in this week, and their aunt passed away, and unfortunately, my client is the executrix of this, and it is unfortunate because all her family members are not very nice. And
money does that to family
it doesn't
members.
it? And one of them was the aunt's broker. And she goes, "Can you look over the estate, make sure everything looks right?" And she hands me an Edward Jones statement. And there's gains of $150,000. And I go, "Well, when did she pass?" "Oh, in August." "And when did you sell the stock?" "In November." I said, "It gained this much money in 3 years? And she gave me all the backup.
3 years or 3 months?
Or 3 months, sorry.
Okay.
Her nephew, the aunt who passed, the nephew never recalculated the cost basis for the estate. So they were going to have the estate pay tax on $150,000.
Oh, wow.
When really, just one of them, it showed a gain of $15,000. It was only $1,000. And so it's a big difference if you use the wrong basis when it comes.
Oh my gosh, that's for sure. Now, under the current tax law, any stock that's purchased, that it's up to the broker to keep the basis for you. However, if you have old stocks that you've purchased over the years, it's up to you to have that basis. And I know you say to yourself, well, it's too hard to do, but the truth is it's your taxes that you're paying, and the calculation, the basis calculation really can affect what you actually pay in taxes.
Well, that's what I was.
Yes.
Oh, that's what I was saying earlier when that person was talking about the house and all the remodeling and all that good stuff. You have to do some work and keep track of your basis.
That's for sure.
Yeah.
Well, we're going to take a short break. 8030930, 8030930, star 930 on a cell phone. Text us at 3930. I'm Esther Gulius, the tax lady. See you on the other side. Hey, this is Esther Gulius, the tax lady from EG Tax. I'm joined in studio with Tiffany Fabian, Christopher Fabian. We're talking capital gains. I think
Hey, I
Tim-
just want to chime in there.
Yeah.
Don't forget, if you get a letter, don't just pay it. To make sure you have us look at it. I can't tell you how many letters are usually wrong or moderately wrong, and so make sure you just have us look at the
because
letter.
the IRS in the state of New York, they basically, what information is put in to their system, they just kind of run a tax return with this information that they have, which may be flawed information because they don't know how you live and some of the deductions that you might take. And so many times when taxpayers come in with these letters, we find out that they didn't know about this was a rollover. They didn't know what year you were born on the state of New York, so they're adding back the $20,000 deduction, things of that nature. So you want to make sure that you don't just pay it. There's no charge to come in for us to take that second look.
One of my clients just got a letter, and that was that one of their employees went to New York State Unemployment Office and they filed for unemployment insurance. However, they were paying them incorrectly, and so New York State subsequently unemployment sent them a letter and said, "I don't think you did this." So this all points to that business seminar that we're doing, and so the importance.
I think I just heard from Tim that there's 2 of them now, 2 business seminars.
No, right?
No, okay.
Chris, you look confused.
No, unless we all of a sudden got an overwhelming response.
No, we got 2 responders who just responded via our website, is what Tim said.
I got you.
Two people just signed up.
I thought, wow, we had over.
And if we
seminars
get more than enough, we will do 2 seminars because we want to make sure everybody knows the best thing
All right,
for
so
them.
Going back, and again, 8030930, 8030930, star 930 on a cell phone, and our text is 3930. Going back to the capital gains, since we have 46 days, when you take a look at your brokerage statement, and just like Chris was saying about the big capital gains, that brokerage statement tells you what kind of potential tax problem you're going to have in April. Now you have 46 days with which to offset those gainers by losers if there's some things in your portfolio that are not performing as well as some of the better things, and you can reduce. Let's say you had 100,000 in capital gains, and let's say you have losers of 70,000. You can actually sell the stocks at a loss, offset the capital gains of 100,000 by your $70,000 in losers. Now you're only up to 30,000 in capital gains, of which you might pay 0%, which is awfully good.
It sounds
right?
like good tax planning.
And that's what you want to do. You want a tax plan. And that's part of what we do at EG Tax. You can call us Monday through Friday this time of year at our corporate headquarters. You can go to our website at egtax.com. And if you don't know how to read your brokerage statement, we'll show you how to read it. A lot of times, and I know it can be overwhelming,
Pages and
some of these
pages.
brokers send you enough paper that you could use it in the restroom, instead of some of the other things. I mean, because they send you statements and it just becomes overwhelming. If you want help reading your brokerage statement, EG Tax can help you.
I know Chris is teaching the advanced class, and he was passing out to all the students a copy of a brokerage statement with everything blacked out. I mean, they have pages and pages and pages. Part of the pages is all the state modifications, and if you have state bonds and what they're taxed at, the rate. And so it's really, really a lot to digest.
Right, that's true. And by the way, if you have municipal bonds are tax-free on the federal, may be tax-free on the state, but it has to be a New York State municipal bond. So if you have municipal bonds in New Jersey, then on New York, even though it's tax-free on the federal, it's taxable on New York.
Right.
Correct.
Right?
Yep.
Okay, let's go to the phones. We got Larry. Hey, Larry, how can we help you?
I got a question on how much I could put into an IRA. I'll give you some details here. My wife makes about $14,000 a year. We're both 60 years old, and basically living off of a beneficiary IRA. That my mother passed away and we're collecting. So,
All right, so how much is how? All right, so she's got the wages of 14,000, right? Your wife.
Right.
And the only other source of income you have is that IRA. How much are you getting from the IRA?
Whatever I want, usually.
Well, how much will you take this year?
$1,500 a month or something.
How much?
About $1,500 a month.
Okay, so you can both do she can do an IRA, you can do an IRA, and so you can put $6,500 both of you away into your IRA. So that'd be the $14,000. So there's no tax liability at all that you would pay.
Like a pretty good deal. And somebody mentioned that to me, and I says I can't believe that she's going to make that, and I'm going to take money out. And
But here's the thing. So because you would have zero liability, you can take more money then out of that out of that inherited IRA to completely tax-free. So you got the 46 days to plan, and what I'd suggest you do is give us a call and we'll figure out exactly how much more you can take out of that IRA from Mom.
And you can
And still
only
have it be tax-free.
You can only do money into an IRA until you reach the age of 70 and a half. And then what Esther was initially talking about was a spousal IRA. So she could put $6,500 herself in, and you could put $6,500 in. And you have to have wages, and you can only do that to the age of 70 and a half.
Right, he's 65.
Yeah. I'm
Right.
just telling
So, but
everybody
the
else.
thing is, you got room, right, Chris, where they can
Yep.
take more money out of that inherited IRA.
Right, because it's going to be reducing the wages basically down to nothing.
Right.
So then if you have 1,500 times 12, that's about 15,000. Your standard deduction is 24,000. You got another $9,000 to play with.
Right.
On the federal. Yeah, and then even New York State, because
On
that will
New
be
York State.
tax-free on New York.
Part
Yep.
of the reason is because of that money he puts into an IRA
Right.
every year. Yeah, and that's good tax planning.
Absolutely.
I got
Okay, Larry?
deal here. Yeah.
All right, thank you. I'm Esther Gulius, the tax lady from EG Tax, 8030930. 8030930 star 930 on a cell phone. All right, so we talked about what a capital gain is. We talked about capital assets, and we talked about that some things are taxed different. The capital gains are taxed at a lower rate. However, if you have rental property, like this gentleman that was called us before, the rental property has to be taxed after you recapture all that depreciation, unless you do a tax-free exchange. Do you guys want to explain that?
Sure, it's taking your business income, your business property, which is your rental property, and exchanging it for another rental property. And what that does is it takes your basis of your new property, so if your old property, so say maybe you bought a property for $100,000, it's fully depreciated. So for tax purposes, your basis is zero. Okay? Now you go around and you want to sell it, you think, and you're selling it for $250,000, that just means you have a gain of $250,000. Instead of paying tax on that, you can exchange your property and purchase a new property and pay no tax on that money. And that new asset, say it's worth $300,000, you reduce it by that gain of $250,000. So for tax purposes, your new property only has a basis of $50,000 because you're not paying tax on your gain. You're deferring that gain until you sell that new property.
And if it goes through your estate, what happens then?
A stepped up basis.
And then your heirs don't pay anything at all. So, I mean, it's really important, this tax planning perspective. I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone. 3930 is our text. Yes.
I just want to say, with inheritance and all that, a lot of people that do come in now are, I sold my mom or my dad's house. And how did you obtain that house? Right? Because nowadays there's a gift, there's a life estate, or there's an inheritance. And they need to know the difference, because when it comes to tax time, because it could mean a major swing in their tax return.
Okay, the other thing is, if you're selling a business asset like machinery or equipment, it used to be that you could adjust the basis of the new machinery or equipment, like a truck, when you traded it in. The only thing that you can then can be used anymore in a trade-in would be, like we just talked about, on a tax-free exchange from real estate. Only real estate has the ability to adjust the basis. If you're selling your vehicle that's used in business, that will result in many times a taxable capital gain, which is going to be taxed as ordinary income. So you want to make sure that if you're going to be selling your truck for business, for instance, that you're aware that that's going to be a taxable event.
Right.
Right? And you got to be
Correct.
careful. So you want to talk to your accountant to make sure that you're ready for that. And then the other thing is when you're getting a stock option, many times people have a cashless option and it grosses up their wages and they're not aware that they're supposed to report that as a sale of stock because it went all through their wages.
Yep,
And
yep.
so it increases their cost basis, and in most situations, they have no taxable event.
Yep. So it's like a wash transaction. And you really want, I can't tell you how many people do that wrong. You really want to pay attention. And the only way you can really look at it is to get one of your pay stubs and to see that they're bulking up your wages with that stock purchase. And so
Right,
that
and,
means
and it's on your when you get your W-2, you can see it
it's
as well.
coded. Yep.
Right?
Yep. That's right.
All right. And then, like Chris had alluded to, selling inherited property, receiving property through an inheritance where it goes through the will. Not that grandma puts your name on the title before her death, but it actually goes through the estate or a life estate. Then you get a stepped up basis, which means that you pay nothing in taxes if you sell it at close to the time when you inherited it, and for all intents and purposes, right?
Correct.
Okay.
Yep.
Anything
And-
else?
But now, if Grandma gifted your house,
Then that's a big problem.
right? So, like, if
Big a problem.
right, if the house was 100,000
Big a problem.
and 50,000 was put into it, so now it has 150,000 cost basis. You sell it for 300,000. You have a gain of $150,000. So about $40,000 in taxes you would have to pay, compared to inheriting it at the 300,000, where you would pay nothing. So
Right.
there's a $40,000 difference.
Change.
Yep, and that's why it can
And that's-
impact.
I mean, to me, that's a lot of money. I don't know. It's a
money.
lot of money. But anyway, EG Tax is there to help you. Our corporate office on Colvin Boulevard is open 9 to 5, Monday through Friday this time of year. Pretty soon, 46 more days, we're going to be there bell to bell, 9 to 9. But in the meantime, we suggest if this has piqued your interest, EG Tax does not charge you for a consultation. We'd love to sit down with you to tax plan before the end of the year. And don't forget, if you have a small business, rental property, you got questions on your business, we have that small business seminar coming up December the 7th, and you can register online or call us. Call Tammy on Monday, right?
That's right.
Yes.
Hey, have a great weekend. I'm Esther Gulius, the tax lady from EG Tax. Chris Fabian, Tiffany Fabian. Have a wonderful week. We'll see you next week. Bye-bye.